Welcome, everyone, to Colony Advisors May Recap. I am Brendan McCarty, Chief Investment Officer and founder of Colony Advisors. I thank you for joining us today. Within this presentation, we will be covering the May performance of our strategies as well as an outlook. This will be framed through the following themes. First, trading opportunities within our trading sliver of our strategies have been few and far between over the past 6 months. As the market has become a one-way train, if you will, to the upside, the dips and the variations from the day-to-day trade has been very limited, except for in certain moments. These limited opportunities have been brought on by massive amounts of money into the system, a massive rise in risk-taking, and a general increase in investors within these markets. With that said, the bull market trend is weakening and uncertain based on some things we will show you shortly. First, in terms of select opportunities, our trading opportunities have been indeed limited. Over the past 6 months, we've been averaging 1 to 2 trades in our trading sliver of our strategies. This compares with 3 to 5 over the past 10 years. This argues that this explains why our returns have not been doing much of anything over the past 6 months versus the previous 6 months, which we saw large swings in price movement in the S&P 500. NASDAQ movement was more regular, and this created opportunities for us to capitalize on. With May producing 1 to 2 trades, May of 2020 had 5, March of 2020 had 9. So you can see how much volatility has fallen. This is largely being driven by the FOMO crowd, who feels that they have to, the fear of missing out, they're getting into the markets, buy. And with every dip, whether it's one day or intraday, they're there to buy. With large amounts of money flowing around the system and leverage with room to run higher, this is the result. In addition to the FOMO trade, there's also uncertain trends developing within the bull market that we currently have. First and foremost, they're erratic. We've seen spikes in volatility at the end of January and February. As this occurred, this affected the primary trend. However, what's interesting is we've seen bounces from these volatility spikes into mid-month and then sell-offs into the end of the month. Part of the reason this is due to is the momentum of money coming into the system is slowing. Yes, the Fed balance sheet is still growing, but it's growing at a slower rate. This slower rate explains why the markets have slowed. Also, inflation and other inflationary assets and other markets, such as crypto, have stolen some volatility away from the equity markets because there's better trading available there. Just ask an FX trader lately where all the volatility went, and it went into the crypto markets. This explains, with this slowing in momentum within the equity markets, we've seen a peak of sorts, at least on the short term. Equity markets in early June have risen a bit, but overall we've been flatlining since mid-April. Risk-taking by investors as a result has fallen. They're not adding to risk to push prices higher, they're backtracking. The PE of the S&P 500 has come lower, and similar examples in 2005 and 2010 produced a flat market in the former and a late year rally in the latter. What made up for the difference in these two markets was a rising earnings trend. So as long as earnings continues to rise, a fall rally can follow. But if earnings stops or stalls and a falling PE continues, you'll start to see markets roll. We're waiting for the next step. As for an outlook, this activity is an indicative of a transition to a bear market. We don't believe so just yet. We still think this is a bull market, and we will show you shortly what the chart of the bull looks like at the moment. It has run high, it has run far, but it still hasn't rolled over. This is our CE growth model. This measures a bull or bear trend. As you can see in the chart drawn in the upper right-hand corner, it peaked in early April, and since then the equity markets have similarly peaked. At least from the momentum standpoint, has slowed. Even as earnings expectations have continued to climb, earnings season was really good this past quarter as well, and yet stocks can't seem to move. Part of that has to do again with the slow in money momentum. As long as money momentum continues to slow, that may remove the market's ability to climb more aggressively. With that said, things look entering June actually look positive for the bulls. This chart does show a break into a new standard deviation outside that range. We believe the next move for this will probably be a moderation in this trend. With a moderation, this trend brings uncertainty, and with uncertainty brings better trading opportunities for our strategies. This is the CEA ERT model, which measures the earnings risk trading within the marketplace. As you can see, this one has peaked as well in very similar fashion to 2010. In 2010, when this model peaked, the May flash crash followed a couple of months later. That is not to say that we'll see another crash in these markets, but it is to say that when risk rolls over like this, it gets harder for an equity market to climb. You need earnings again to fill the gap. If this were to move lower, 2010 was a decent year for our models. It was back-end loaded with a strong year-end rally. If we see a year-end rally in similar fashion, we could start, that would benefit our strategies and the trading environment as a whole. If we do not see that, we could have flat returns similar to 2005, which was also a decent trading environment, which in either case, I'm optimistic in terms of our trading behavior benefiting return going forward. So in terms of an outlook, as we said, there's a better trading conditions on the horizon, we believe, based on the positive returns we generate on our strategies in May. In contrast to that, the first 4 months of the year, we had very limited trades and not much opportunity. But May has turned the corner, we believe in that. We believe the rise in uncertainty is contributing to that, which will create even more opportunities, taking us from 1 to 2 trades a month back to our traditional 3 to 5 trades a month. That is a normal trading environment for markets right now being driven lower in terms of that trading behavior by the massive amounts of money. Will the primary trend change come later this year? That's uncertain. Our outlook for 2021 did not look for a rollover in the bull market. However, this is anything but a normal bull market. If there is a rollover, September of 2000 was a peak for the bubble. Fall of 2000 was the peak for the housing bubble. One could say we're seeing a bursting of a crypto bubble of sorts, and maybe there's the commodities markets to some extent, though there's more of supply constraints. In any event, with uncertainty rising, that is helpful for our strategies, and I'm optimistic that things will continue to improve June and onward. Well, thank you very much for joining us for our May recap on the strategies. You can read more about Column E at columne.com, about our team, about our strategies, our foundation video series, which we're launching, and you can catch what our latest thoughts are between the columns. Thank you again for watching, and I hope you have a great week ahead of you. Talk to you.